Is a stagflation brewing? Here's everything you need to know in this video. So the first thing that we need to see is the gold price, and if you can take a look at this chart over here, there's some sort of like a deja vu that is happening in today's gold price point versus in the 1980s.
Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description.
So for your context over here, in January 1980, when the nominal price of gold hit approximately about 850 USD, which is around 3,590 USD in 2025 dollars term, the United States was grappling with a collapsing national currency and also stagflation. This sounds eerily similar to today's situation where the USD is weakening and also jobs growth are actually tapering down. There's also more job losses. There's more weekly jobless claims, as well as the inflation also is starting to go up. So you can see that we have some sort of like a similarity as compared to the 1980s, whereby they were facing a stagflation. So back to today, which is around 2025, this is the latest news in September 11. The US consumer prices are increasing more than expected in August. Now, mind you, Mr. President Donald Trump actually said that inflation is actually not going to be so high, but he was proven wrong again. The latest CPI report is actually growing in terms of numbers, and there is a concern that the CPI numbers can go up to maybe even 3 to 4% next year due to the tariff. So we shall see whether this number will continue to increase. And if it does, it will signal stagflation. You also can see the US employment rate is now trickling up. Previously, it's about 4% to 4.2%. Right now, it's about 4.3% based on the 2025 August data. And if you can look at the monthly job creation over time, it actually dropped quite a fair bit in the recent data. So overall, the unemployment rate or employment data is actually very, very bad in the US. And this actually increases the probability of rate cuts for the 17th of September. We are going to be having another FOMC meeting coming soon, which is this Thursday in Malaysia's time. We will see most likely a 25 basis point cut. But there's also some, probabilities whereby the Fed or the market thinks that they can actually going to be cutting a 50 basis point, but most likely it's going to be about a 25 basis point. And mind you, also, we have another 2 more FOMC meeting, which is coming on the October as well as December. So we will see whether there will be even more rate cuts, given that there's a very weakening data at the moment for the US. So how did stock market actually perform during a stagflation? This is analysis that is derived from ChatGPT. So you can see over here, the classic example of stagflation occurred in 1970s, which is particularly between 1973 and 1982. And this is how the stock market performed during that time. So number one, there is a poor real returns. While the nominal stock prices stayed flat or even increased a little bit, real inflation adjusted returns were negative. And you can see from 1966 to 1982, the S&P 500 had essentially zero growth. Inflation eroded purchasing power. And just for your example, between 1973 to 1974, the S&P 500 lost about 48% in nominal terms, which is worse when adjusted for inflation. And the 2 winning sectors that we have over here, number one, it is energy stocks or oil companies. They did well because of the rising in terms of commodity prices. And the second thing, which we're already seeing right now, the gold and precious metals also went up because investors want to hedge this inflation or rise in inflation. On the other hand, the losers were the consumer discretionary. This makes sense because people would pull back in terms of their spending in discretionary products. So discretionary are things like your wants. So like your handbags, clothing, or maybe even trips. All of these things are considered discretionary. What that happened was consumers don't want to spend more. They are more inclined to save more or spend on necessity products like your groceries, food, water, all those kind of things. And also they did mention that the tech stocks and also financial stocks underperform because there is a higher interest rate and lower consumer spending. What's this fun is because the Fed is going to be reducing rates, which is pretty soon already. However, if you read The Edge, which is an article written by Tong, he mentioned that the US will be facing some sort of higher inflation, higher for longer inflation, which this would encourage a higher for longer interest rate. So most likely, what is this trying to say is that the US interest rate, the Fed might not be doing a very steep cut. So most likely the interest rate will still be hovering around like 3%. My guess is probably around 3.5% to maybe even like 4%-ish. So that will definitely erode the consumer spending. Now you can see that what's interesting or what is different from today versus in the 1970s was that the Brent oil is going down. So previously the Brent oil was definitely much more higher in terms of prices as compared to today. And you can see today's price is around like 67 USD per barrel. And S&P Global expects that this price will eventually hit 55 USD per barrel by year end because the OPEC Plus, they will be increasing production. So this is an interesting time that we are facing, which is totally different from the 1970s, whereby the oil prices went up, gold also went up. But today, the gold prices is going up, but the oil prices is staying depressed. But if you read Tong's latest article, he did mention that the depressed level in terms of Brent oil will not be staying low for very long. So eventually it will start to rebound back. But that is his own opinion. And if you look at these two companies, which is related to the tech or AI space, Oracle and also Alibaba, these two companies is still performing very, very well. And if you look at the year-to-date numbers, Alibaba is up 80%, whereas Oracle is up 77%. Maybe this time is different because in today's era, the AI companies or tech companies, they have a lot of cash. They are very cash rich. And also they have very little debt. Plus, they are an asset-light business model, which means they don't own a lot of hard assets. They own more like patents, IPs, trademarks. All these kind of things are more essential to run their business. And not to mention, the manpower is actually the key resources to run their business operation. So that's also a very, very key thing in today's era as compared to the .com era, which is in the 2000s, and also the other tech bubble burst era in the 90s. So there's some sort of like difference in terms of this. However, we still cannot rest our laurels because there are still signs that the market might be overheating. If you look at today's S&P 500 is closing at its all-time high. Gold prices also at the same time is closing at its all-time high. So markets are still very optimistic. They still don't foresee some sort of weaknesses, although macroeconomic data show there is some sort of weaknesses. And also, not to mention, insiders, CEOs are kind of like cashing out their positions. But who knows what will happen, right? It could go up a little bit more from today, but it also could go down tomorrow. So that is something that you need to be cautious. So here are the final thoughts. In the end, consumer purchasing power matters. So currently, what is driving up earnings for Nvidia and other tech companies like Oracle is a lot of this transaction is done B2B, which is business selling to another business. And thus far, there's not much of a B2C other than just OpenAI, giving up subscription to us so that we can use their large language model. But that said, the big money still comes from B2B, whereby you can see in this article, OpenAI had just signed a contract to buy a 300 billion in computing power over 5 years from Oracle. And also Oracle, they are buying a lot of AI chips from Nvidia. So you can already see the pattern over here is more towards B2B. And in the end, we need to see whether this AI spending can it translate down to making money from the consumers, which we have not been seeing yet. We have Tesla, they are trying to build out Optimus, which is the robot. So when that comes into the market, maybe that's where we can start to see some sort of like B2C movement, which is consumers are buying the AI products besides just large language models. Okay, the second thing is not all rate cards are the same. So based on Carson Investment Research, you can see there are different types of rate cards. So there are rate cards where it's normalization, where there is a panic card, and there is a recession card. And you can see that based on the 1 month, 3 month, and 6 months, as well as the 12 months projections, and this is based on the S&P index future returns. So for normalization card, it's more like a maintenance card for the Fed. So that means the Fed is cutting rates at the right time. So you can see a majority of the time when they do a maintenance cut, the S&P 500 index future returns actually increases a lot. Whereas for panic, you can see that the 1 month and 3 months where S&P 500 goes higher is about 50-50. But in the long run, which is 6 to 12 months, the S&P 500 returns would still go back to positive. In contrary, for a recession cut, usually the probability of the S&P 500's future returns to go higher, it starts to become harder to actually go up. So you can see over here, the first month, although 67% of the time the S&P 500's returns go up, but in 3 months, 6 months, that probability start to drop to zero. So this tells us that when the Fed cut rates a little bit too late, or when during a recession they need to cut rates, that is the time where the S&P 500 actually underperforms despite a rate cut. So this is something that you guys need to take note of at current market. It's because the S&P 500 is still rallying a lot. So that is something for you guys to take note of, whether this rally can continuously to go up, or would there be a sign where there will be a minor correction. And generally speaking, in the months of September and October, if you look at some of the insiders or CEOs in listed companies, some of them are starting to cash out. So for instance, the Nvidia CEO Jensen Huang, he also recently decided to sell or pare down his stake in Nvidia. Not only just him, not only just Nvidia, but multiple tech companies' CEO are also cashing out. The third point we have over here is Bitcoin can be your leading indicator. And if you notice, Bitcoin prices is very sensitive to economic data. So when there is good economic data, they'll go up. When it's bad, it'll also go down. But another thing that you also need to take note is there seems to be like a topping-ish at current price point. So if you look at previous top in 2022 as well as 2024-ish, you can see that when they top, there will be a steep correction over here and over here as well. This one is still minor, so that's still like a normal kind of like correction. But it appears that at current price point, which is around 115,000 per coin, it seems like they cannot really break through that all-time high, which is around 120,000. So if they cannot break through that level, most likely there will be a correction, and it could be a leading indicator for stock markets because Bitcoin, it is risky assets. So if Bitcoin cannot break through the 120,000 point, this tells us that there is some sort of like topish in the crypto space. And what this means is potentially there will be some sort of correction coming soon. So pay attention to Bitcoin because it is being traded daily and also 24/7. So if there's some sort of like major correction going on, probably there will be a sign that the stock market also will follow suit. And last but not least is how should you be positioning in this potential stagflation, potential correction market, right? We are still a firm believer of staying invested in the market, especially staying invested in high quality companies that have a continuous catalyst in the future. So that is number one, very key. Number two is that these companies are being run by great management who would walk the talk and they wouldn't lie about their data. And number three is that these companies are cash flow positive, free cash flow positive with minimum cost of capital. They don't need to reinvest a lot of money back into their business to make more money. So if let's say their cost of capital is capped at a certain level and at the same time their earnings or cash flow can grow up, then their ROIC can definitely increase a lot. So these are companies that we are staying invested in. And last but not least, it is a bonus. Obviously, you want to look at companies where they can pay out dividends, not share buybacks in Malaysia because, they prefer to pay out more dividends as a form of appreciation for minority shareholders. So those are the 4 key things that you should be invested in, which are high quality companies. But if you are more cautious about today's market, keeping aside a percentage of cash inside a portfolio is also a good thing to do. Just in case if there's some sort of correction, then you can buy your high quality companies at a cheaper price. So this one is up to you how many percentage of cash you plan to hold. It could be 20%, 10%, 30%, or even 50%. So it depends on your risk tolerance or what do you think the market would do in the future. So you can position yourself a 10%, 20%, 50%, or even 70% of cash into your portfolio. That's totally fine because everybody is different, right? So make sure you guys stay prepared for the unexpected. And before you guys go, this is the August 2025's performance. So far, we have been doing pretty well. September also will be even better than today's return, obviously. So August 2025, we make about 38% for FIRL Malaysia. For the global portfolio, it is up 15.8% and the borrowing is up 6%. And if you are new here, you don't know what is FIRL. It's basically a program where we share our write-ups. What are write-ups? Is basically our analysis on companies that we find interesting. And we do a very short form, kind of like a write-up or report. It only takes you about 10 to 15 minutes to understand everything you need to know about the company. Whether is it the business, management, the risk, the catalyst, and also the valuation, which is very, very important. And just to share with you guys, here are the stocks, undisclosed name inside our portfolio. Some of them are already up 3 times, 4x. Some of them even have risen up 2x in just a few months. So if you want to know what are the names behind all of these portfolios, make sure you guys join FIRL, and there's a 10% coupon. The links will be in the description and comments. And if you are a dividend lover, you prefer cash flow, then you might want to check out the boring portfolio, because this portfolio's dividend yield is about 8.6% and it's higher than EPF's 2024's number, which is around 6.3%. And if you notice over here, there's 3 companies that is still having like a 0% dividend yield. Well, that's because they haven't really started paying out the dividends. And these are companies that we actually initiated just recently. So if you're joining, then you will know the names that we bought just a few weeks ago. The links also will be in the description and comments. And not only just write-ups, but we also do share with you guys how we do our management notes. So management notes is basically information that we write it in our Word document, and it's basically meetings with CEOs, with industry experts, with other analysts on their take about the company. And we share with you guys 3 management notes over there, 2 write-ups. One is KGB, the other one is Delium. So just for your reference over here, we initiated KGB around late October 2022, and since then it have went up 4x. So if you want to see how we do our write-ups, it's inside the free sample. And that being said, we will see you guys in the next video.